Intro. Hi, my name is Christopher. Welcome to this journey through accounting. Today, we are going to study the chapter, which is Financial Statements Preparation. In this chapter, we'll explore the key components of financial statements: trading account, profit and loss account, balance sheet, and notes to accounts. We'll also understand adjustments like depreciation and provision for bad debts, and see how final accounts of a sole proprietorship are structured. By the end, you will be able to connect the accounting cycle with the preparation of formal financial reports. Introduction to financial statements. Financial statements are formal records summarizing financial activities of a business. They provide insights into profitability and overall financial position. Management uses them for decision-making, while external users like investors and regulators rely on them for accountability. They also fulfill legal and tax obligations. Essentially, financial statements transform raw data into meaningful business intelligence. Components of financial statements. This slide identifies the four core statements. The trading account shows results from buying and selling goods. The profit and loss account calculates net profit after expenses and incomes. The balance sheet shows assets, liabilities, and owner's equity on a specific date. Notes to accounts provide explanations and breakups of reported figures. Together, these create a full financial picture of any business. Trading account, purpose and structure. The trading account determines gross profit or gross loss from trading operations. It considers opening stock, purchases net of returns, and direct expenses like wages or carriage. On the credit side, it records sales net of returns and closing stock. Gross profit, sales, cost of goods sold. This account helps owners evaluate how efficiently trading activities are run before overheads. Trading account. Format. Here we see the debit and credit format. The debit side includes opening stock, purchases, and direct expenses. The credit side records sales and closing stock. The balancing figure is gross profit carried down. If costs exceed sales, the result is gross loss. This standard structure makes trading results comparable across businesses. Profit and loss account, purpose and structure. The profit and loss account starts with gross profit from the trading account. It deducts expenses like salaries, rent, depreciation, and interest. It adds incomes like commission or discounts received. The outcome is net profit or net loss. This account reveals the overall profitability of operations after considering all costs. Profit and loss account. Format. On the debit side, we list all expenses such as administrative, selling, distribution, and financial charges. On the credit side, we include gross profit and other incomes. The difference between the two sides gives net profit. Net profit is then transferred to capital or reserves. This format ensures uniform presentation across industries. Balance sheet, purpose and structure. And the balance sheet shows financial position on a particular date. It follows the equation assets, liabilities, plus equity. Assets include fixed, current, and intangible categories. Liabilities are divided into long-term and current. Owner's equity represents the owner's claim, including capital and retained earnings. A balance statement proves double entry accounting. Balance sheet. Format. This slide shows the actual structure. Liabilities side includes capital, profits, loans, and payables. Assets side includes land, buildings, machinery, stock, debtors, and cash. Both sides must total the same. This format provides a snapshot of solvency and liquidity. It is the most widely used presentation for financial reporting. Notes to accounts, purpose, and importance. Notes provide context behind numbers. They disclose accounting policies, contingent liabilities, and related party dealings. They also mention post-reporting events and break down major items. Without notes, financial statements might mislead users. Notes enhance transparency and strengthen decision-making. Depreciation accounting, concept and importance. Depreciation spreads the cost of assets over their useful lives. It ensures expenses are matched with revenues. It accounts for wear and tear, ensures funds for asset replacement, and prevents overstated profits. The two main methods are straight line, equal charges yearly, and written down value, percentage on reducing balance. Choosing the right method ensures fairness and consistency in reporting. Depreciation accounting, journal entries. Depreciation is recorded with journal entries. The depreciation account is debited, and the asset account is credited. Then depreciation is transferred to the profit and loss account. On the balance sheet, depreciation appears either deducted from assets or in a separate provision account. This systematic recording ensures both profit and asset values are shown realistically. Provision for bad debts, concept and necessity. Provision for bad debts estimates potential customer defaults. It follows prudence, don't overstate assets, matching, match expenses with revenues, and accrual principles. Firms analyze debtor aging, calculate provision, and record it. This provision ensures receivables are not overstated. It helps present a true and fair view of financial position. Provision for bad debts, journal entries. The first entry creates the provision, debit profit and loss, credit provision for bad debts. When actual bad debts occur, debit bad debts and credit debtors. Later, the provision is adjusted against written-off amounts. On the balance sheet, provision is deducted from debtors. These entries ensure consistency and fairness in receivables reporting. Final accounts of sole proprietorship. This slide explains the full cycle for a small business. It starts with journal entries, moves to ledgers, and then trial balance. Final accounts include trading account, profit and loss account, and balance sheet. Together, these show gross profit, net profit, and overall position. They provide owners with a complete financial picture of their business. Summary: financial statements, preparation. The chapter comes together here. Financial statements include trading, P&L, balance sheet, and notes. Adjustments like depreciation and provisions make them accurate. They fulfill legal needs, guide management, and build investor trust. For sole proprietors and large companies alike, these statements provide clarity on performance and solvency. Mastering their preparation is essential for any accountant.